They don't care about the relationship between real interest rates and the price of gold. They don't care about the strong dollar. They don't care about any of this stuff. They don't care about these correlations, right?
Thanks for tuning into Silver News Daily. Subscribe for daily news content and price speculations. David Hunter, a seasoned macro strategist with over 50 years of Wall Street experience, has been vocal about his predictions for a significant financial phenomenon known as a melt-up. According to Hunter, 2024 is the year this is expected to unfold dramatically, particularly affecting the silver market. But what exactly is a melt-up? In financial terms, a melt-up refers to a sharp rise in the performance of a market segment, driven more by investor sentiment and speculative purchasing than by underlying economic fundamentals. This surge is usually followed by a stark correction or meltdown. In Hunter's analysis, the silver market is primed for such a surge. His bold prediction sees silver reaching a staggering $805 per ounce by April 2024. This forecast is rooted in a combination of factors, including a physical silver shortage, increasing industrial demand, and speculative investment flows, which are beginning to outweigh the available supply dramatically. Silver's current dynamics and shortage. The foundation of Hunter's prediction begins with the current dynamics in the silver market. Recent reports and data from entities like the Silver Institute have highlighted a growing physical shortage of silver. Production has been waning, with significant mines like the Penasquito mine experiencing decreased output, while industrial demand, especially from sectors like photovoltaic, solar industries, has surged to all-time highs. This mismatch between decreasing supply and increasing demand is a classic precursor to a price surge. Yet the current price of silver, which has hovered around flat levels for years, doesn't yet reflect this tension. According to Hunter, this discrepancy between price and physical market fundamentals sets the stage for a rapid revaluation once market participants recognize the severity of the shortage. The role of investor sentiment. Investor sentiment, driven by the perceived scarcity and future price potential of silver, is likely to exacerbate the melt-up. As more investors come to understand the depth of the shortage and the potential for substantial price increases, speculative buying is expected to increase, pushing prices even higher in a short period. Hunter's commentary suggests that the current market setup, where silver is vastly undervalued due to market manipulation and a misunderstanding of the underlying supply-demand dynamics, is ripe for a rapid correction. He points to the historically low investment allocations to silver relative to other assets and the limited amount of silver available for investment as critical indicators that the price of silver could explode upward as the reality of the market's physical tightness becomes apparent. Preparing for the surge. For silver stackers and investors, the preparation involves recognizing the signs of the melt-up and understanding that silver is more than just a store of value. It is an asset that could see exponential growth in value in a short time. With the US dollar's potential weakening and global economic uncertainties, silver's role as a historical currency and store of wealth becomes even more critical. As Hunter suggests, the upcoming market movements are not just temporary fluctuations, but could be a return to silver being a fundamental aspect of global financial systems, especially as trust in traditional fiat currencies wanes.
So it looks to me like a market that has a long ways to run here. My targets on the S&P is, my target on the S&P is 7,000, NASDAQ 23,000, the Dow 55,000, and the Russell 2,000, I think, can get up to 3,300. And I am beginning to think those numbers may prove conservative. They're certainly a long ways from here, so I'm not raising targets or saying they will exceed that. But I think it's a high conviction call for me that we have a big run still ahead. And frankly, we just had a short consolidation in the markets. One in the first half of March, then we kind of had a little rally and then another consolidation recently. And it looks to me like the market's coming out of that short consolidation and you're about to see another run here. So I know a lot of people who have been bearish all the way up have joined the bull party and say, yeah, I agree. It's broken, the market's to new highs. I think I'm more bullish, but I need to see this thing correct, and then maybe it can go. I don't think you're going to get that opportunity. I think this thing's going to just kind of have these short little pauses that refresh and then just go again. Now, somewhere in here, you could have a bigger pullback, but I don't think that.
David Hunter emphasizes that one of the pivotal drivers of the predicted silver melt-up in 2024 is the burgeoning demand from industrial sectors, particularly for photovoltaic, PV, solar cells. This increasing demand is critical to understanding why silver might reach unprecedented price levels soon. Here's a deeper dive into this aspect. The role of industrial silver. Silver possesses the highest electrical and thermal conductivity of all metals, making it an indispensable component in various industrial applications. Among these, the most significant in recent years is its use in photovoltaic solar cells, which are essential for solar panels. As global initiatives towards renewable energy have accelerated, so too has the demand for silver, given its crucial role in solar technology. In 2024, this demand is not just steady but surging. With countries around the world committing to greener policies and reducing carbon footprints, investments in solar energy have skyrocketed. This has led to an all-time high demand for photovoltaic cells, directly influencing the demand for silver. Hunter points out that this is not a temporary trend, but a sustained one that will continue to put pressure on silver supplies. Supply constraints. Concurrently, the silver mining industry has not kept pace with this explosive demand. Production declines, particularly at major mines like the aforementioned Penasquito, have led to a worrying trend where annual silver production is falling at a time when it should be expanding. This discrepancy between growing demand and shrinking supply is a textbook scenario for higher prices. Hunter highlights that the current silver supply is at its second lowest in a decade, a situation exacerbated by logistical challenges and geopolitical tensions that affect mining operations worldwide. These supply constraints are not quickly resolvable, suggesting that the supply shortage may worsen before it gets better. The investment implication. For investors and silver stackers, the increasing industrial demand coupled with supply shortages suggests a bullish outlook for silver prices. However, understanding this demand is not just about recognizing the quantity, but also the quality of demand. Industrial demand for silver is largely non-speculative and deeply integrated into production processes, meaning it is not as susceptible to economic downturns as other types of demand might be. This kind of robust demand supports long-term sustained increases in silver prices, rather than short-lived spikes. Strategic actions for investors. Given these dynamics, David Hunter.
Yeah, I see this a lot in the markets. Is people kind of have recency bias, whatever they remember as the most recent actions, or they think that's forever, or that's always going to happen. We've had times when the metals go with the market, and times when they are very much counter to the market. If you look at the first decade of this century, from 2001 to 2011, we had a huge bull run, and that was also a time when we had pretty good stock market during periods of that time. So there have been times like this when the stock market can be going up and the metals can be going up at the same time. So I had that question a lot when I was bullish, when everybody was bearish, and they said, they're not going to go up together. And I said, I think they are. And so I think you have to step back and realize that there's no one formula for these things. Sometimes they move with the market, and I think this is one of those times.
Understanding the psychology behind investor behavior is crucial in anticipating the market dynamics that could lead to the silver price surge David Hunter forecasts. Market sentiment, particularly how it shifts in response to economic signals and perceived opportunities, plays a pivotal role in driving rapid price movements or melt-ups in asset markets, including silver. The power of market sentiment. Market sentiment refers to the overall attitude of investors toward a particular security or financial market. It is an aggregate of the hopes, fears, and expectations of market participants, and it can dramatically influence price movements. In the context of silver, positive sentiment can be sparked by a variety of triggers, such as news of supply shortages, technological advancements that increase silver's utility, or broader economic trends favoring precious metals. David Hunter points out that the sentiment around silver has been significantly influenced by the realization of its physical market dynamics, namely, the ongoing supply shortages and increasing industrial demand. As more investors become aware of these factors, the sentiment shifts from cautious to optimistic, potentially becoming exuberant as the price begins to climb. This shift can attract even more investors, creating a self-reinforcing cycle that drives prices up at an accelerated pace. The role of speculative investors. Speculative investors play a critical role in the dynamics leading to a melt-up. These are participants who invest in assets like silver, not just for long-term preservation of value, but for short-term gains based on expected price movements. When speculators believe that silver prices will rise sharply, they are likely to increase their holdings, which adds upward pressure on prices. Hunter notes that in a scenario where industrial demand continues to outpace supply, speculative interest in silver is likely to grow. Speculators often move quickly and in large volumes, magnifying their impact on the market. Their activities can exacerbate the mismatch between supply and demand.
I think the dollar has just this week finally finished that counter trend rally it's been in for a while. It was causing a lot of people to get, more kind of jump on the bandwagon and say, oh, the dollar has more to go. There's going to be, might go to 109 or it might go to 110 or 108. We got up to 105 and change, but I think it's rolled over now. We'll find out. It's very early in that move if it is, but I continue to say we'll see the dollar down at 80 this year. And that's a long ways from where we are. So if the dollar goes down, that's very bullish for the precious metals, very bullish for the miners. It's bullish for the commodity sector as a whole, for sure. And I think that's what we're likely to we're just seeing now.
As David Hunter has extensively discussed, economic policies play a fundamental role in shaping the trajectory of silver prices. These policies can influence investment flows, alter currency values, and affect global trade, all of which are critical components in the pricing of silver. Central bank policies, particularly those related to interest rates and quantitative easing, are especially influential. Lower interest rates often decrease the yield on fixed income investments like bonds, making non-yielding assets such as silver more attractive. In a scenario where central banks around the world adopt more accommodative policies to stimulate economic growth, silver could benefit significantly. David Hunter points out that the anticipated melt-up in silver could be catalyzed by such dovish policies. If central banks respond to economic slowdowns by slashing rates or implementing more aggressive asset purchases, the resulting liquidity and lower interest rates would likely drive investors towards silver as a hedge against currency devaluation and inflation. Moreover, fiscal policies, including government spending on infrastructure and technology, can also affect silver demand. Increased spending, particularly in areas like renewable energy or telecommunications, which rely heavily on silver, can directly increase demand for the metal, pushing up prices. David Hunter also considers the regulatory environment as part of the economic policy landscape affecting silver. Changes in mining regulations, environmental laws, and trade tariffs can alter the supply dynamics by either constraining production or making it more expensive. These supply-side shifts are crucial in a market where physical shortages are already forecasted. Inflationary pressures also play a vital role. As governments implement large-scale fiscal stimulus, the risk of inflation increases. Since silver is traditionally seen as an inflation hedge, higher inflation expectations can lead to increased demand for silver, both from institutional investors and retail buyers. David Hunter has emphasized that these economic policies are not isolated factors, but interlinked elements that collectively influence investor psychology and market dynamics. When analyzing the potential for a silver melt-up, it is essential to consider how these policies might evolve in response to global economic conditions, and how they interact with other factors like industrial demand and supply constraints. By understanding the broader economic policy environment, investors can better anticipate shifts in the silver market and position themselves to capitalize on potential price movements. As Hunter suggests, the setup for a significant increase in silver prices is rooted not only in market dynamics and investor behavior, but also deeply influenced by the economic policies enacted by governments and central banks worldwide.
I think you're right. The narrative that's going to help drive this is going to be, we've come through a tightening cycle and now the Fed is beginning an easing cycle, or will be beginning an easing cycle. And it will be easy to buy into what will be the call of the day, the narrative of the day, which is, this is the beginning of a new easing cycle. That means there's a long runway ahead. And they may be saying that right at the top of the secular bull market, because, if the Fed's just beginning to ease, usually easing cycles last, the tightening cycle lasted, a couple of years. The easing cycle might last 3, 4, 5 years or more. The problem is that's probably not the case, and frankly, there's things going on below the surface that suggest to me that, first of all, the Fed might come back and tighten right after they cut rates. They might say, well, look at the markets, responded to us and gone straight up. We got to take some of these animal spirits away, and they could actually hike rates again and start the whole thing going the other way. Secondly, this is economic forecasting is not about, monthly numbers or, the last quarter's GDP. There's a lot going on below the surface that doesn't necessarily show up in all of that. So I believe below the surface, we have we certainly have a have-not economy that represents maybe 80% of people that are struggling to get by, that are struggling to meet their daily budgets. And then we have a 20% that are, gleeful here saying my wealth just keeps going up. Housing, which had a great run, is showing signs of strain. Yes, it could have bounces along the way here in the spring if rates come down a bit. But, basically, I think we're seeing a secular top in housing.
David Hunter has highlighted the significant impact of global economic conditions on the silver market, particularly in relation to its price movements. The interplay between global economic health and the demand for commodities like silver can often dictate market trends and investor behavior. Global economic stability, or the lack thereof, can dramatically influence silver prices. In times of economic uncertainty, investors often flock to silver as a safe haven, similar to their behavior with gold. This is because silver, like gold, is considered a store of value in turbulent times. However, silver also has significant industrial uses, which means its demand can be buoyed by economic activity, particularly in the industrial and technology sectors. David Hunter points out that the ongoing technological advancements and the global push towards renewable energy are critical factors supporting the demand for silver. The metal's properties make it indispensable in various applications, including electronics and solar panels, sectors that are expected to grow irrespective of broader economic challenges. Conversely, economic downturns can also affect silver prices, but in a dual manner. While investment demand might increase during such periods, industrial demand could taper off if manufacturing slows down. This dual influence makes the reaction of silver prices to economic conditions somewhat complex and multifaceted. Furthermore, global trade dynamics also play a crucial role in the silver market. Trade policies and agreements between major silver-producing countries and consumers can significantly affect the availability and price of silver. For instance, tariffs on silver exports or imports can create supply bottlenecks, driving up prices temporarily. David Hunter emphasizes the importance of monitoring these global economic indicators and trade dynamics as they provide essential clues about potential shifts in the silver market. Economic recoveries or downturns in major economies like the USA, China, and the European Union have a pronounced impact on silver prices due to their substantial influence on global trade and investment flows. The interconnectedness of global economies means that a financial crisis in one part of the world can lead to increased volatility and speculative trading in silver markets globally. The anticipation of such scenarios is what drives a seasoned strategist like David Hunter to forecast significant movements in the silver market. In understanding the broader context of global economic conditions, investors are better prepared to navigate the complexities of the silver market. Recognizing the signs of economic shifts and understanding their implications on both the industrial demand and investment appeal of silver is crucial for anyone looking to capitalize on the predicted melt-up in silver prices. This nuanced understanding of global economics not only helps in making informed investment decisions, but also in anticipating market trends that could affect the profitability of silver investments.
I mean, gold had basically a triple top, maybe even a quadruple top there before it broke out. Started back in 2020. It ran up to the high 2000 area, went back down, came back up in 21 and again in 22. And we're finally breaking through to new highs. And once it broke out, you started seeing people kind of jump on the bandwagon. So you've got legs there. My target on gold is 3,000 this year. what I call pre-bust. Doesn't have to coincide with the top of the equity market, but I think it's likely to be this year. And it's, a short-term move. And I think we're going to see pauses along the way, but generally you had your consolidation, so don't sit around looking for another one, because I think this thing is, you're just getting started. And silver, which has, gold at new all-time highs. Obviously, silver's a long ways from its old highs and has been the laggard for a long time. As you say, the gold-silver ratio is up, was up at 89, I think, and is just starting to come back down. We've had a good couple weeks in silver. And I think there's that party is just getting started. So I think silver can, and my long-held target is 60. I think that can be seen, if not by the end of this year, and I think it very well could be by the end of this year, be early next. So, 60, and I've said recently, if it breaks 60, you could run to 75 very quickly. So 60 is still my target, but I wouldn't be surprised if that's low. That's a long way. I mean, silver's, just been in the kind of low 20s range for quite a while. Finally has moved up to 27, and I think could move very quickly to the mid 30s and then maybe pause and run again, or certainly move up into the low 30s and pause and run again. So, you're going to have, I think, a lot of upside in the miners as a result of this. And I think investors who have been kind of disillusioned by particularly silver, but by the miners, because it took so long, a lot of those that were bullish and expected these breakouts before have kind of thrown in the towel. It's taking them a while to believe this rally, because I think, I've seen this before, I'm not buying it. And so it's, that's how healthy skepticism that will keep these things running.
David Hunter has often discussed the role of silver futures markets in determining the price of silver, which he believes are key areas where market manipulation can occur. Understanding the dynamics of these futures markets is essential for grasping how silver prices are influenced beyond simple supply and demand. Futures markets allow investors to buy and sell contracts for the delivery of silver at a future date. These markets are intended to provide a mechanism for price discovery and risk management, but can also be platforms where large players exert significant influence on prices. Speculators and large institutional investors can sway silver prices dramatically by taking large positions in these markets, often leading to price movements that do not align with underlying physical market conditions. David Hunter points out that the disconnect between the physical silver market and the futures market can be stark. For example, even during times of reported shortages in the physical market, futures prices may not rise proportionately if large futures traders are positioning for lower prices. This can create scenarios where the physical scarcity of silver is not accurately reflected in futures market prices, leading to frustration and confusion among smaller investors and physical silver holders. Market manipulation in this context often refers to the strategic buying and selling of futures contracts to influence silver prices in a desired direction. This manipulation can be for various purposes, such as profiting from short-term price movements or controlling the price for longer-term strategic advantages. Accusations of manipulation are not uncommon in commodity markets, and silver is no exception. The role of regulatory bodies becomes crucial in this environment. These bodies are tasked with ensuring fair trading practices and preventing market abuses that can lead to manipulation. However, the effectiveness of regulation is often a subject of debate within the investment community. David Hunter suggests that investors need to be aware of the potential for manipulation and consider it when making investment decisions. Moreover, understanding the futures market is also important for anticipating how silver prices might respond to economic events or changes in market sentiment. For instance, if major market players anticipate an increase in industrial demand or a shift in monetary policy that could devalue currencies, they might take positions in silver futures that preemptively drive up prices. For investors following David Hunter's predictions, it's advisable to monitor developments in the silver futures market as part of a broader strategy. This includes staying informed about the positions major institutional players are taking and any regulatory changes that might affect market operations. By doing so, investors can better understand the sometimes perplexing movements in silver prices and align their strategies to take advantage of potential rapid increases at market value during the predicted melt-up.
The concern about rates here recently, because they've pushed back up. People have to remember the 10-year fell from 5% to 380. So all we did when it went from 380 back to 440 was basically a 50% retracement, which is a normal consolidation. And I suspect that consolidation's pretty much run its course. So as with the dollar, I think rates are rolling over here. I wouldn't be surprised to see rates heading for 3% soon. That's not what's on the street right now. Everybody's focused on some new breakout in inflation and economy getting stronger. We get these ebbs and flows in terms of, month-to-month readings, and the street kind of in their infinite wisdom of being traders and looking at every data point and extrapolating it, kind of go a little too far with it. It's possible we could have a few months where it goes the other way, but my sense is we're still seeing inflation trending down. The economy is still softening underneath the surface. Jobs that everybody wants to say are strong. A lot of the strength is in part-time. There's been no growth in full-time jobs. So all in all, I think, at worst, I think we're in a steady as she goes, not, heating up type situation. And actually probably more likely we're in what we saw for several months last year, a period of softening, which allows inflation to continue to move towards their 2%.
David Hunter emphasizes the critical impact of technological innovation on the demand for silver, which is anticipated to be a major driver in the melt-up of silver prices. As technology evolves, the applications for silver expand, not only in existing markets but also in emerging ones, thereby enhancing its value and demand. Silver is integral to various high-tech applications due to its exceptional thermal and electrical conductivity. It is used extensively in the electronics industry for components such as conductive pastes used in printed circuit boards and contacts in electronic devices. As the global demand for consumer electronics continues to grow, so too does the demand for silver. Moreover, one of the most significant technological advancements affecting silver demand is the expansion of the renewable energy sector, particularly solar energy. Silver is a key component in photovoltaic cells, which are used to convert sunlight into electricity. The global push towards renewable energy sources to combat climate change has led to increased investment in solar infrastructure, subsequently increasing the demand for silver. David Hunter points out that as countries and corporations continue to invest in and expand their renewable energy capacities, the demand for silver will likely increase in correlation. This is not merely a temporary spike, but a sustained growth trajectory that aligns with global energy policy shifts towards greener alternatives. Additionally, the automotive industry's shift towards electric vehicles, EVs, involves silver. Silver is used in various electrical connections and conductive paths in EVs. As the automotive industry continues its rapid shift from internal combustion engines to electric power, the demand for silver is expected to rise further, driven by the increased production of EVs, which rely heavily on advanced electrical systems. This increase in technological applications for silver creates a robust case for its long-term demand growth. However, it also presents challenges in ensuring sufficient supply to meet this demand, especially in the context of current production declines in major silver mining operations. This imbalance between growing demand and constrained supply is likely to result in upward pressure on silver prices. David Hunter's analysis suggests that understanding the relationship between technological innovation and silver demand is crucial for investors. It offers insights not only into the potential reasons behind price increases, but also provides a basis for strategic investment decisions. By closely monitoring technological trends and their implications for silver usage, investors can better position themselves to benefit from the anticipated rise in silver prices during the predicted melt-up.
Very much. I have been on record as saying that the highs in the stock market this year, and as I say, I think 7,000 on the S&P is my target. If we reach that high, or whatever high we reach this year, and if that's the secular top I'm calling for, I don't believe we'll get back to those highs or anything close to those highs again in the next couple decades, and maybe longer. This is a major final thrust into a top. And the reason for that is because first we're going to have this 80% bear market in the global bust. Global bust is something I don't people hear the name, the term, but I don't think they really understand how significant that is. It's nothing like what they've lived with in post-World War II era. It's going to be a short-lived, I think, relatively short-lived, 12 or 18 months. But you're going to be wondering what's coming out of that because it's, bank failures, it's a lot of things. So it's 2008-9 was kind of a precursor to it. So you got a pretty good taste of what a financial crisis looks like. This one, I think, is going to be worse. But coming out the other side of that, because the central banks are going to have to respond so aggressively to that bust, the printing of money to a degree we've never seen in this world, and 2020 was beyond anything we'd ever seen. This will be 4 or 5 times that, will trigger an inflation cycle in the post-bust era, meaning 2026 and beyond, and could culminate in inflation getting up as high as 25% in this country by the end of the decade or early next decade. If that's the case, that really shrinks PE multiples, market multiples. Stocks are very interest sensitive, and if interest rates are going down as they were the last 40 years, generally trending down, it boosts price earnings multiples. It boosts the market multiple tremendously. You get the reverse of that, where rates are moving towards high double digits, and price earnings multiples or a market multiple that's 20 or 25 can move back down to single digits. So that puts a real damper on equity markets. There will still be many stocks that will perform in that environment, mostly commodity producers, precious metal miners, industrial companies that serve those industries. So there'll be places to make plenty of money in the next cycle following the bust. But the stock market as a whole, index funds as a whole, will face a very stiff headwind that's going to cause them to underperform and maybe even go negative during that time.
David Hunter often discusses the significant role the U.S. dollar plays in the valuation of silver prices. The relationship between the dollar and silver is inversely correlated. Typically, when the dollar weakens, silver prices rise and vice versa. This dynamic is crucial for understanding the potential triggers for the melt-up in silver prices that Hunter predicts. The U.S. dollar serves as the world's primary reserve currency, and its strength or weakness can have far-reaching implications for commodities priced in dollars, including silver. A weaker dollar makes silver cheaper for holders of other currencies, which can increase demand, and consequently, the price of silver. David Hunter points out that several factors could lead to a weakening of the dollar. These include expansive monetary policies like lower interest rates and quantitative easing, which the Federal Reserve might employ in response to economic slowdowns. Such policies increase the supply of money, potentially devaluing the dollar and boosting silver prices as investors seek to protect their wealth from currency depreciation. Moreover, geopolitical events or shifts in global economic leadership can also impact the dollar's strength. For instance, increased economic uncertainties or international tensions can lead to investors moving away from the dollar towards safe havens like precious metals, including silver. This shift typically results in a rise in silver prices. Hunter also highlights the role of international trade balances in affecting the dollar. A significant trade deficit, which occurs when a country imports more than it exports, can pressure the dollar and make commodities like silver more attractive. As global trade dynamics evolve, especially with the rise of economies like China and the European Union, the dollar's dominance on the international stage may be challenged, influencing silver prices. For investors following David Hunter's guidance, it is advisable to keep a close watch on the dollar's performance and the factors influencing it. Understanding these dynamics can provide crucial clues about when significant movements in silver prices might occur, allowing investors to position their portfolios accordingly. By considering the broader economic context, including the health of the dollar, investors can better anticipate and react to changes that might lead to a surge in silver prices. This strategic approach aligns with Hunter's views on the interconnectedness of global financial markets and the complex, often indirect ways in which they impact commodity prices like silver.
Yeah, I think in the bust, as I say, there's going to be a melt up in the equity markets, and then a bear market following that will be accompanied by a global bust, which is a big financial crisis and economic downturn. In the bust, you could see, let's say I'm right about the 3,000 target on gold. There's nothing that says it can't come back here. So gold could go from 3,000 back to, 21 or 200, or, which was, back to the breakout point, basically. And there's no magic to my target that it couldn't, it certainly could be exceeded. So you might be, 33 or 4 or 500 before it stops and then comes back, and it may not come back as far. Who knows? Silver is going to be the more volatile metal. If it goes to 60, I doubt that it comes all the way back to the low 20s, but it could. If the stock market's going to drop 80%, there's nothing that says silver can't drop by 60% or 70%. So, it's a much more economically sensitive and volatile metal. So there may be another opportunity in the bust, but between now and my targets, I think you're not going to get these kind of opportunities again. They'll pause. Silver can have can go to 35 or 6 and then back to 30, or gold can go to 2,500 back to 2,350. I don't know what the path's going to be exactly, but trying to guess that is difficult. And when there's so much upside, it's like, this thing is, I want to re-emphasize, I think this thing is just getting.
David Hunter often discusses the significant role the U.S. dollar plays in the valuation of silver prices. The relationship between the dollar and silver is inversely correlated. Typically, when the dollar weakens, silver prices rise and vice versa. This dynamic is crucial for understanding the potential triggers for the melt-up in silver prices that Hunter predicts. The U.S. dollar serves as the world's primary reserve currency, and its strength or weakness can have far-reaching implications for commodities priced in dollars, including silver. A weaker dollar makes silver cheaper for holders of other currencies, which can increase demand and, consequently, the price of silver. David Hunter points out that several factors could lead to a weakening of the dollar. These include expansive monetary policies like lower interest rates and quantitative easing, which the Federal Reserve might employ in response to economic slowdowns. Such policies increase the supply of money, potentially devaluing the dollar and boosting silver prices as investors seek to protect their wealth from currency depreciation. Moreover, geopolitical events or shifts in global economic leadership can also impact the dollar's strength. For instance, increased economic uncertainties or international tensions can lead to investors moving away from the dollar towards safe havens like precious metals, including silver. This shift typically results in a rise in silver prices. Hunter also highlights the role of international trade balances in affecting the dollar. A significant trade deficit, which occurs when a country imports more than it exports, can pressure the dollar and make commodities like silver more attractive. As global trade dynamics evolve, especially with the rise of economies like China and the European Union, the dollar's dominance on the international stage may be challenged, influencing silver prices. For investors following David Hunter's guidance, it is advisable to keep a close watch on the dollar's performance and the factors influencing it. Understanding these dynamics can provide crucial clues about when significant movements in silver prices might occur, allowing investors to position their portfolios accordingly. By considering the broader economic context, including the health of the dollar, investors can better anticipate and react to changes that might lead to a surge in silver prices. This strategic approach aligns with Hunter's views on the interconnectedness of global financial markets and the complex, often indirect ways in which they impact commodity prices like silver.
So in that time, what does thrive, and we can go back to the late 70s and early 80s to compare a similar period. What does thrive in that are the precious metals, are the commodity producers, are the metal miners. So I really think, and energy, and those are kind of the areas that I think will be the big winners in the next cycle. And that's a lesson for all investors, is that every cycle, and I've been doing this 50 years, so I've seen many different economic cycles and market cycles that go along with those economic cycles. Each market cycle has a different leadership. So this cycle, it's been the tech, it's been the growth areas that have been the leaders. The next cycle will be much more the value side of the equation, much more the cyclicals, much more the inflation hedge stocks. And the ones that will suffer will be a lot of the ones that were the leaders this time. So it causes investors to have to be a bit aware that it's not a straight line. It's not just keep doing what you do. And there are times when buy and hold, just put it in the index fund works. And there are times when that's a terrible strategy.
David Hunter, a seasoned macro strategist with extensive experience, predicts a significant surge in silver prices, which he refers to as a melt up, potentially reaching as high as $805 per ounce in the near future. This prediction is grounded in a multifaceted analysis of the silver market, encompassing various economic, industrial, and financial elements. Here's a comprehensive summary of the key factors contributing to this forecast. Supply and demand dynamics. The foundational element of Hunter's prediction is the physical market dynamics of silver. He notes a growing discrepancy between the decreasing supply and increasing demand. The supply constraints, exacerbated by reduced outputs from major mines and the rising industrial demand, particularly from sectors like photovoltaic, solar cells, and electronics, underpin the fundamental drivers for the price surge. Industrial demand. Silver's extensive use in various high-tech applications, especially in renewable energy and electronic sectors, sustains its robust demand. As global initiatives towards greener technologies and infrastructural advancements continue, the demand for silver, due to its unmatched thermal and electrical conductivity, is expected to surge. Investor behavior and market sentiment. The market sentiment towards silver is increasingly bullish, influenced by its physical market shortages and growing industrial uses. Speculative investments driven by these perceptions are likely to push prices up rapidly, as investors flock to silver as a hedge against economic instability and inflation. Economic policies. Accommodative monetary policies such as low interest rates and quantitative easing typically decrease the yield on fixed income investments, making non-yielding assets like silver more attractive. Such policies, especially in response to economic slowdowns, are likely to decrease the value of fiat currencies like the US dollar, making silver, priced in dollars, cheaper and more attractive to international buyers. Global economic conditions. The global economic climate plays a crucial role. In times of uncertainty, silver is seen as a safe haven. However, its dual role as an industrial commodity means that its demand can be both a boon and a bane, depending on the economic conditions, affecting its price differently during economic booms and recessions. The dollar's influence. Silver prices are inversely related to the strength of the US dollar. A weaker dollar generally leads to higher silver prices as it becomes more affordable for investors holding other currencies. Factors leading to a weakening dollar include expansive U.S. monetary policies and significant trade deficits. Technological innovation. Advances in technology that increase the use of silver, particularly in green technologies and electric vehicles, are set to boost demand. As these industries grow, driven by global shifts towards more sustainable practices, the demand for silver will likely increase, putting further pressure on its price. Silver futures and market manipulation. The futures market plays a significant role in price setting for silver, with large institutional players potentially swaying prices. Understanding these dynamics is crucial for anticipating price movements and potential manipulations in the market. Preparing for this anticipated melt-up in silver prices involves a strategic approach, staying informed about the influencing factors, diversifying investments in silver, monitoring futures markets for early indicators of price shifts, ensuring liquidity to manage volatility, and setting clear investment goals to navigate the complexities of the market effectively. David Hunter's analysis presents a compelling case for potential explosive growth in silver prices, driven by a confluence of factors spanning economic policies, market dynamics, and technological advancements. Investors looking to capitalize on this potential surge will need to navigate with insight and caution, leveraging a deep understanding of both the macroeconomic indicators and the inherent market sentiment surrounding silver.
That could start going the other way. Europe's not in good shape. The rest of the world, China's not in good shape. There's a lot of headwinds out there that can kind of cause that narrative about the Fed to be off. So I just caution people, psychology drives markets as much as fundamentals. And the psychology at the top, when we get there, we're not there. We're just beginning to move psychology from that bearish mode it was in for 2 years to a where institutions are now beginning to buy into this being a bull market with legs. Give it time. That's what the next 3 to 6 months is about. In that time, it's going to be natural for investors to get more excited because they're driven by the up move in the market, by the momentum of the market, or as I say, the momentum of the tape. You have to guard against becoming so bullish at the exact wrong time, because as you're going up in the market, you're getting more bullish, and there's a point at which that maximum bullishness is also maximum stock market, and it goes the other way. History shows, and that's why I'm a contrarian, at market tops, you have the highest level of bulls. At market bottoms, you have the lowest level of bulls. That's why I was so bullish in October of 2022 when everybody else was bearish. You're going to see, I think, within the next 3 to 6 months, me turning very bearish at a time when everybody else is going to think I'm crazy doing so and tell me why I'm wrong. So you just have to understand market psychology, investor psychology, and not get caught up in that.